Hello friends, this is ProVG. Welcome to my channel. Today we are going to discuss about financial freedom. Do you want financially free in the next 5 to 10, 15 years? Not just someday that could change the rest of your life. If you still think your money is safe in a fixed deposit, you are losing money without even knowing it. The time of easy 8% FDs is coming to an end. Today, I'll give you a clear, measurable plan for 2026 that includes what to save, where to invest, and that exact habits that will set you free. Just numbers and steps, no fluff. The Sensex is looking at the 1 lakh mark, and we are on our way to becoming the third biggest economy in the world. But here is the problem. India is getting richer, but the cost of an aspirational lifestyle, travel, iPhones, private school, and housing in Tier 1 cities is rising faster than your salary. If you are counting on a standard corporate appraisal of 8% to 10%, you are only just keeping up with the cost of living. Hello, this is ProVG. This video shows you six things you can do right now to make a strong personal finance plan for 2026 and beyond based on recent Indian data and market conditions. Context and why. Now, you should have thought about these things earlier. The household savings rate in India has dropped to about 18.1% of GDP in financial year 24, which means that many families are saving less, spending more, and taking on more debt. That makes it even more important to plan ahead in 2026. Quick market truth. Long-term equity returns in India have also been good. For example, the Nifty 50 has given annualized returns of about 15% over long periods of time. This shows how patient equity investors can build wealth. Nifty 10-year or 14% per annum historical data. The first rule is rate cut cycle, the RBI changing its mind. This year we will probably see cuts to the repo rate. This is good for your home loan EMI but bad for your savings. It's a bad idea to keep too much cash in the bank as FD rates go down. The second rule is the capex bull run. The government is spending a lot of money on things like railroads, defense, and green energy. This is not just news, it's where the money is going. You are missing out on the biggest rally of the decade if your portfolio doesn't include India's manufacturing and infrastructure story like PSUs, infra, power, etc. Rule 3, Real Estate versus REITs. Many people can't afford to buy a flat in Mumbai, Bangalore, or Gurgaon anymore because rental yields are still only 2 to 3%. Action item: stop worrying about buying a real flat to invest in, buy it only to live in. Instead, check out REITs, Real Estate Investment Trusts, in 2026. They have entry points as low as 300 rupees to 400 rupees, pay out regular dividends, and take the EMI stress off your shoulders. The Indian AI wave is a rise in income. According to NASSCOM and staffing reports, niche skill hikes are going up while average IT hikes are leveling off. India is becoming the world's AI back office, but the gap is getting bigger. Salaries are going up in a K-shaped way. The upper K, people who are good at Gen AI, data analytics, and cloud security. The lower K, traditional coding, BPO, and administrative jobs. Step 1. Make an emergency fund. Investopedia says this is a rule you have to follow. Most people should have enough money saved up to cover their living expenses for 3 to 6 months. If you work for yourself or the only person who earns money, you should have enough saved up for 6 to 12 months. Store this in a safe liquid way like high yielding savings accounts, sweep in FDs, or ultra short debt funds. If your monthly costs are 60,000 rupees, your emergency fund should be between 1.8 lakhs to 3.6 lakhs. Step 2. Get rid of debt that costs a lot. Pay off your credit card debt and high interest personal loans first. The interest rates on these loans are often higher than the returns you could get from the safe investments. Choose the snowball or avalanche method based on whether you need to feel good about yourself or pay off your debt in the best way possible. Step 3. Make savings automatic and treat it like a bill. Set up an automatic transfer of at least 20% of your net income to savings or investments the day you get paid. Set up an automatic transfers to your emergency fund and an auto SIP. Automation takes willpower out of the equation. Goal: save at least 20% of your net income after paying off debt. Put your money to work by investing it over time and in the right assets. For most working people, this is a good way to divide things up. Safety: cash plus short-term debt 10 to 20% for an emergency fund and a short-term goals of 0. Income or moderate hybrid funds debt 20 to 30% for the medium term 3 to 7 years. Growth through direct stocks or equity mutual funds SIPs 50 to 60% over the long term 7 plus years. In India, a reasonable long-term expectation for long-term equity SIPs is about 10 to 15% per year. This varies by fund and period. Let us say you put 5,000 rupees into equity funds every month through SIP. If you get a reasonable long-term return that could grow to about 11.6 lakhs in 10 years. If you keep putting money into the same SIP for 15 years at about 12% per year, it could grow to about 25.2 lakh rupees. After 20 years, it could be worth about 50 lakhs, which shows the power of compounding. These are examples projections based on a 12% annualized rate for monthly SIPs, 5,000 rupees a month, 11.62 lakhs, 25.23 lakhs, 15 years, 49.96 lakhs, 20 years. These are all subject to market conditions. Let's look at the investments in the market. The core large caps put 60% of your stock money into a Nifty 50% index fund. It's cheap, and these top 50 companies will lead the way as India's economy grows to $5 trillion. The alpha, mid and small caps. Mid caps are where the explosive growth is, thanks to the story of domestic consumption, people buying cars, phones, and travel. Put 20% of your money here through active mutual funds, but be ready for changes. The Desi hedge, that is, Indians love gold and they have good reasons too. It's being bought by central bank. Don't buy jewelry because the making charges will eat into your returns. If you can find them in secondary markets, buy sovereign gold bonds or gold ETFs. You get safety and capital. Step 5. Planning for taxes and a note on regulations. Use tax efficient tools whenever you can. For example, use ELSS funds for tax saving, SIPs, NPS or EPF for retirement, and long term equity for favorable capital gains. Note: changes to policies in 2026, like the recent announcement of higher transaction taxes on derivatives, could affect the cost of short-term trading. This is another reason to choose long-term investing over active trading, reports Reuters. Step 6. Diversifying your income and creating passive cash flows. Set a goal to have 2 to 3 sources of income in 5 years: a main job, an investment income stream like equity dividends, rental income or debt or fixed income, and a side business or freelance work. The building blocks of financial freedom are passive rental income, dividend income, or a strategy for taking money out of a retirement account. Passive income target is equal to monthly expenses into replacement ratio, example 80%, is a concrete goal. You can have a goal like in the short term, 1 year, build an emergency fund and pay off high interest debt. In the medium term, that's up to 3 to 5 years, you should save 20% of your income and have 3 to 4 SIPs across large cap, index, mid cap, or flexi cap. Long term, 10 to 20 years, a portfolio that gives you passive income that is at least equal to your current expenses through dividends or systematic withdrawals. Rebalance every year to manage risk. If stocks do better than expected and make up 70% of your portfolio instead of the 60% you wanted, sell some and move to safer assets. Don't try to time the markets. Instead, rebalance to keep your risk level the same. One of the precautions is don't ever use your emergency fund for things you don't need. Precaution 2. Don't chase the hottest stock or fund without knowing how to value it. Past winners can do worse. Before you go, here is one page checklist. Get rid of lazy cash, put extra FD money into debt, mutual funds, or hybrid funds. Ride the capex wave. Make sure you have some exposure to India's infrastructure story through Nifty or certain funds. Get better at your job. Look for the A premium in your pay. An emergency fund should last for 3 to 6 months. Get rid of debt that costs a lot. Save more than 20% automatically. SIPs in different types of equity funds. Rise SIPs as salaries go up. Review taxes and rebalance every year. Create at least one source of passive income. Outro: getting out of debt is not a magic. It takes time, good habits, and a smart spending. Start today and build on what you learn tomorrow. Please understand, India is in a golden decade. Don't just sit back and watch the Sensex hit new. Start your SIP, make it bigger, and get your freedom. Your financial freedom is in your hands. Plan properly, achieve your goals bigger and bigger. This is ProVG, and if you like it, please share it with others and please subscribe to my channel. Thank you very much.